Today, I want to present on the cost volume profit analysis. The learning objective for the cost volume profit analysis or the CVP analysis. So there are 4 learning objectives. Number 1, to explain the definitions of cost volume profit analysis. The learning objective number 2 is to explain the CVP assumptions and limitations. The learning objective number 3 is to determine the break-even point, the target volume to achieve desired net profit, the margin of safety using equation method, and the contributions approach. And the learning objective number 4 is to construct the break-even chart, contribution chart, and the profit volume chart. What is cost volume profit analysis? A CVP analysis is based on the relationship between volume and sales revenue, the cost and profit in the short run. It provides an analysis of what will happen to the financial results or the level of profits if activity or volume fluctuates. The analysis is useful to plan the future productions and sales activity that will enable the firm to maximize profit, and at the same time, it enables firm to determine the break-even point and the margin of safety of the firm. This information is especially important to ensure that survival of the firm is short run and also in long run. CVP analysis helps managers to evaluate the impact of alternative product pricing strategies on profit. It can also be useful for evaluating competitors' pricing strategies and efforts to grow market share. It adopts the principles of marginal costing approach, where costs can be divided into fixed costs and variable costs. Each analysis is applicable in short run only. Therefore, firm has to do analysis every time there is any change in the cost and the volume. So there are 7 assumptions of cost volume profit analysis. The assumption number 1 is costs can be divided into fixed and variable element. Number 2, the unit selling price, unit variable cost, and the fixed costs are known and constant. Assumption number 3, the fixed costs incurred during the period are charged as expenses for that period. Assumptions number 4, the revenues and costs are linearly related to product within the relevant change. The assumptions number 5, single product is sold or multi-products sold in accordance with predetermined sales mix. The assumption number 6, the analysis is not impacted by the time value of the money. And the assumption number 7, labor productivity, the production's technology, and market conditions do not change. And there are 4 limitations of the cost volume profit analysis. Number 1, it is difficult to separate the cost into fixed and variable elements. The limitations number 2, the unit variable cost and the selling price might change. Number 3, the fixed costs remain unchanged within a relevant range, but outside relevant range, fixed costs might increase or decrease. And the limitations number 4, labor productivity, productions, technology, and market conditions might change, and this will affect the cost volume profit analysis. So let's see what is break-even point, or the BEP. The break-even point is the level of production and sales at which a product or service stops losing money and becomes profitable. So at this break-even point, the profit equals 0. Once we know the break-even point, we can assess the financial viability of a new product or analyze our current operating performance. So basically at BEP, the total revenue is equal to the total cost. So the profit is 0. It indicates the minimum sales volume in units to produce and sell to reach break-even. So there are 3 methods to determine the break-even point. Number 1, the contribution margin method. Number 2, the equations method or the mathematical method. And the third is graphical method. The first method, that is the contribution margin method. The contribution margin is total revenue minus the total variable cost. Similarly, the contribution margin per unit is the selling price per unit minus the variable cost per unit. Both contribution margin and contribution margin per unit are valuable tools when considering the effect of volume on profit. Contribution margin per unit tells us how much revenue from each unit sold can be applied towards fixed costs. Once enough units have been sold to cover all fixed costs, then the contribution margin per unit from all remaining sales becomes profit. So this is the formula to calculate the the break-even point using the contribution margin methods. The break-even point in units can be calculated by using this formula, that is the total fixed cost divided by the contribution margin per unit. And the break-even point in Ringgit Malaysia, the formula is total fixed cost divided by the contribution margin over sales, or the break-even point in units times the unit selling price. The contribution margin per unit, the formula is unit selling price minus the unit variable cost. And the contribution margin over sales, the formula is unit selling price minus the unit variable cost divided by the unit selling price. The second method is the equation method. This method uses a bit of simple maths to answer different cost, volume, profit questions. The total revenues are found by multiplying unit selling price by quantity sold. Also, the total costs are made up firstly by the total fixed costs and secondly by the variable costs. Total variable costs are found by multiplying the unit variable cost by the total quantity. And any excess of total revenue over total cost will give rise to profit. By putting these informations into a simple equations, then we can come up with this formula. The sales revenue is equal to the unit selling price times the quantity sold. The total cost equal to the total variable cost plus the fixed cost. And the total variable cost is equal to the unit variable cost times the quantity sold. The sales revenue minus the total cost is equal to net profit. How to get the sales revenue? The unit selling price times the quantity. And the total cost consists of the total variable cost plus the fixed cost to get the net profit. As we know that at break-even point, the profit is 0. Therefore, the sales revenue, that is the unit selling price times the quantity, minus the total variable cost, that is the unit variable cost times the quantity, and minus the total fixed cost is equal to 0. So at these equations, it is at the break-even point. And then the third method is the graphical method. A cost volume profit graph enables us to visualize the relationship between sales revenue, the total cost, and the number of units sold, and the profit. The sales volume is recorded along the horizontal axis, while sales revenue and the total cost are shown on the vertical axis. The total cost and the total revenue lines are plotted on the graph. The point where the total cost and the revenue lines intersect is the break-even point. The amount of profit or loss at different output level is represented by the distance between the total cost and the total revenue lines. So let's see the break-even chart. Okay, if you look at this graph, it is customary to use the horizontal axis for the unit output. Okay, and then the vertical axis for the values like sales, revenue, and total cost. So this is for the monetary values. The sales revenue, look at this sales revenue, makes an angle of 45 degrees from the starting point at 0 RM and 0 quantity volume. It is at 45 degrees, the sales revenue line. All fixed costs, this is the fixed cost. All fixed costs remain the same at all output levels, so fixed cost line is drawn across the chart as straight line parallel to the horizontal axis. The variable cost line, this is the variable cost line. Okay, this is the variable cost line. Commence from the vertical axis from the same point where the fixed cost line intersects with the vertical axis. So this is to show the total cost of the charts. Okay, this is the total cost of the chart, where the total variable cost and also the fixed cost, okay, it's combined here. That's why it started from here. On the chart, the break-even point represent the point at which the total cost and the total revenue, total cost and total sales revenue lines cross to each other. So this is the break-even point. The break-even point so determined tells the reader that the break-even point in terms of units in output on the horizontal axis, and in terms of sales revenue and total cost on the vertical axis. Okay. The shaded below the break-even point, this area is the losses, indicating losses. And the shaded area above the break-even point indicates profit. This is profit, this is loss. The profit and loss on break-even chart may be determined by looking at the vertical distance between the sales revenue line and the total cost line. Okay. So the difference between the prevailing sales and the break-even sales represent margin of safety. So this is the margin of safety, both in terms of sales revenue and output level. So this chart shows the contribution chart. This is the variable cost line. Okay, at zero productions, the variable cost is zero. So the variable cost line is parallel with the total cost. This is the total cost line. So the difference between the variable cost and the total cost is the fixed cost. So it's starting from the variable cost line until the sales revenue line. So this is the contributions margin. Okay, contributions. And this is the profit volume chart. This is the break-even point. Anything below the axis zero line is loss area, and anything after the break-even point above the zero line is profit area. Margin of safety, or the MOS, is the amount by which actual or the budgeted sales may allow to fall without incurring a loss. So the formula for the margin of safety in units is the budgeted or the actual sales unit minus the PEP unit. And the margin of safety in monetary value, that is in RM, the formula is the budgeted or actual sales in Ringgit Malaysia minus the BEP in Ringgit Malaysia, or the margin of safety in units times the selling price per unit, or the profit over the contributions of sales ratio. The higher the margin of safety, the higher the expectations of profit. The applications of cost volume profit analysis. The CVP analysis is important to determine the targeted net profit, or to determine the sales level in terms of units, or the monetary value of Ringgit Malaysia if given a target profit. Okay, the formula for sales in unit, if a company is given a targeted net profit, the formula is total fixed cost plus net profit divided by the unit contribution margin. And the sales in Ringgit Malaysia is the total fixed cost plus the net profit, the targeted net profit, divided by the contributions over sales. Okay, next is sensitivity analysis. Sensitivity analysis shows how the CVP model will change with changes in any of its variable. For example, changes in fixed costs, or changes in the variable cost, or changes in sales price or sales mix. So the focus is typically on how changes in variable will alter the profit. So there are 4 areas that may change the break-even point that can be measured using certain sensitivity analysis tools. That is changes in the fixed assets, the selling price, the variable cost, and the sales volume. So this is how to present a marginal costing income statement. First, the company's name, and then the name of the income statement, that is the marginal costing income statement for the year ended. And the first item is the sales revenue less the variable cost of sales. So there's all the variables items listed under this variable cost of sales. It could be the direct materials, the direct labor, the production's overhead, and the selling and distribution's overhead. So after the sales revenue minus the total variable cost, then you will get the total contribution margin. And then less the total fixed cost. The fixed cost consists of the fixed production's overhead, the fixed selling and distributions, the fixed administrations. So the contribution margin less the total fixed cost, then we get the net profit.